Welcome to Wealth Building Starts Now. I'm Eric Hersey, and I'm here with partner and wealth advisor Steve Waters with Riverbridge Wealth Management. And today we're going to be talking about the One Big Beautiful Bill Act of 2025 that just passed this year. And there is a lot of legislation that affects how taxing is being performed or being tax matters for that notion. And with that being said, we need to talk to some professionals that help us with that advising. So today it's a big topic, lots of things to talk about today, Steve. So I'm going to kick it right off to you to give us an overview of what we're going to be looking at today.
Yeah, thanks, Eric. Looking forward to our conversation today. Yeah, this is a significant piece of legislation that just came through Congress. And, this thing's like 800 pages long.
And you got them all, right? You printed them all out. There's a missing tree somewhere.
We've got them all, but we don't want to bore people to death with going through every minute detail. So we really want to focus on the issues that will impact our clients the most.
Right.
So our, business owners, retarees, physicians, executives, et cetera. What part of this impacts them the most? We want this to be our top 10. We want to keep this to be 20, 30 minutes so that everybody has a good understanding.
Listen, I think everybody will be very appreciative if you can take 800 pages and turn it into 20 minutes. I think everybody in life would be happy with that. But all right, so let's start off. What do you think is the most impactful, at least for your clients and people you're talking to? What do we kind of care about the most?
Yeah, I mean, the most important thing is that the tax brackets are staying the same by and large. So back in 2017, President Trump's signature legislation was the Tax Cuts and Jobs Act. So the One Big Beautiful Act codifies that legislation and keeps the tax brackets the same. The reality is that if this bill was not passed, that 60% of Americans would have seen a tax increase. And if you look at the tax brackets, of course, the top tax bracket that stays at 37%. But the biggest thing is that the bands within each tax bracket, they stay wider. Whereas, before everything would have reverted back to what it was in 2017. And that's really what is most impactful for the large majority of people.
So with this tax staying the same here and essentially not reverting back, where people should be saving more than if the bill didn't pass, correct?
Absolutely, yeah. People will see more in their paychecks as a result of the bill passing.
Well, and that's good because that gives you flexibility to kind of make decisions with that extra money to determine what you're going to do for the future, right?
Absolutely.
Okay. What's the next big thing on this list here?
So the federal government has what's called the lifetime estate tax exemption. So what this is the amount of money that someone can pass to their beneficiaries at their death free of federal estate tax. Anything above that number gets hammered at a 40% federal estate tax rate. Okay.
Right.
And so the One Big Beautiful Act, that increases that amount to the highest level that we've ever seen. Starting next year, it'll be $15 million per person.
Okay.
Even a few presidencies ago, it was as low as $1 million that you could pass to the next generation. So for high net worth families and individuals, this is big.
Right. That's a lot of money.
Yeah, it's $15 million per person, and it's $30 million for a married couple. So for the very large majority of people, they don't have to worry about paying a federal estate tax. So there's a lot of kind of intricate planning strategies that come into play where we can take advantage of this for those high net worth families now, because there's always a chance. This is something that is always reviewed by Congress. If the Democrats had taken power last year, they were talking about reducing that to $7.5 million, and that's where there's a lot more people in play. So it's something to keep an eye on. But the One Big Beautiful Act codified that $15 million per person, and that'll increase each year with inflation. Okay,
so essentially anybody that's planning for inheritance or looking at next stages after someone passes away, where the 40% is no longer going to be taking almost half of the money. We're looking at a far better for everyone else. So getting that kind of plan in place with someone like yourself makes sense.
Yeah. So for the large majority of people, they don't have to worry about the federal estate tax.
Right. Well, I think that's good to know, or at least to be able to plan for. What's the next thing we have? We have SALT, which I've heard this before. What is SALT tax?
So this is state and local taxes. Okay. And so this got a lot of play in the media because it was something that Congress was kind of hung up on. So this is the amount of money that you're able to deduct from your tax return.
Okay.
The state, so however much you pay, you can then deduct that from your federal tax bill. And so there were a lot of people in Congress that were in higher income tax states, such as New York,
Right.
Massachusetts, et cetera,
Right.
that were like, hey, we can't vote on this unless we give our constituents a little bit of a break here. So they did some negotiating, and they increased it to $40,000. So now everybody can deduct up to $40,000 from the state and local tax. What's interesting though is that starts to phase out if someone that's making like $500,000 a year, and once you're at $600,000 a year, it reverts back to the $10,000.
Okay.
So what's interesting is that a lot of the people that this was meant to help, it really doesn't help them. Those high income earners. But
Right.
anyways, that's a change.
But you hear that a lot with people talking about the SALT tax and what you can do for that.
Right.
What now? This one affects a lot of us. It's what just standard deductions, but for what married couples and just the total amount that you can make. Right?
Yeah. So the standard deduction it was increased for a married couple by $1,500 this year. So it was $30,000. Now it's going to be up to $31,500 next year. But what's some really great part of the bill is for people that are over the age of 65. So if you're over the age of 65. You get an extra $3,100 if you're married. So your standard deduction is up to $34,700. Okay.
Right.
But then there was also a lot of play. The Trump administration talked about there wasn't going to be any tax on Social Security.
Right.
That's not exactly what happened. What they did is if you're over the age of 65, you can get an extra $6,000 deduction per person. So $12,000 more for a married couple. So when you add all these up, if you're over the age of 65, your standard deduction is like $46,700, which is huge.
Right.
Now there are some income limits on that. So your adjusted gross income, it has to be under 150,000, or else some of these deductions that I just mentioned start to phase out. But I mean, this is great where a lot of older people's income it's just deducted, and so their tax is going to be much lower because of that $150,000 income threshold that I mentioned. This is another important consideration whenever we talk about the Roth conversion strategies that I mentioned before. You don't want to convert enough that's going to bump them over that 150 limit, because then they start to lose some of these deductions.
So that was the big thing that when I was kind of going over some blogs and kind of trying to understand a lot of this stuff before I talked with you, what is this, like an IRMA? There's an IRMA situation, right? Does that sound familiar?
Yeah, that's for healthcare. That's another bracket.
But that's a similar concept. So if you understand like, hey, we're talking here, you can't make over this because then you'll get hit with a percentage, right?
Exact same thing. It's just another thing that we need to keep an eye on whenever we're talking about Roth conversions. Right.
All right. So we talked a little bit about standard deduction and the Social Security. What is this charitable deductions at $1,000 per person? How is that different, or how does that affect us?
Yeah. So this is another great thing that's in the bill. So historically, right, you needed to be able to itemize in order to take advantage of any charitable donations, right? And so in order to itemize, you need to get over the standard deduction amount, which is $30,000. So, I mean, even if you could write off like your mortgage interest, that counts towards the deduction. But a lot of people then don't gift enough on top of that to be able to itemize it. They'll get a bigger deduction if they take the standard deduction. So how many people give $500 or $1,000 to the church every year, and they get no tax benefit from that. As a result of the new legislation, those people can now write off. It's called an above the line deduction up to $1,000 per person or $2,000 per married couple, which is a great thing because it incentivizes, you're already giving money to the church anyway. Right. You might as well be able to take advantage of that tax break.
So what we got to just keep our receipts and keep documentation, right?
Exactly.
I'm sure the tax accountants will tell you what to do there. But all right, so we're talking more about charitable donation stuff. So what's this gifting?
Yeah, so you
might have to explain this one to me.
This is one of the negatives with the bill, and so there's now a 0.5% floor on your income, and so let's just walk through an example.
Okay.
So let's say a married couple. Let's say your joint income is $200,000. Okay.
All right.
1/2 of 1% of that is $1,000.
Okay.
All right. So let's say you're itemizing. Let's say you're going to give $20,000 to charity in this year. As it stands right now, you could write off the whole 20,000. Okay.
Right.
But now with this floor, it's minus the 1,000, which is half of the adjusted gross income. So you can only write off 19,000.
Okay.
Okay. It's just not as it's a way to kind of claw back a little bit of tax revenue that they're giving up with some of these other provisions.
Right. So a little bit more complicated math, but it's probably not the biggest thing in the world for a lot of people, but enough to complicate it slightly, right?
Right.
All right. So now we have what we call the Trump accounts, and I understand a little bit about this, but what do we have for the Trump accounts?
Yeah. So for children that are born between 2025 and 2028, the federal government is going to open an investment account for those babies, and they're going to fund it with $1,000.
Right.
That $1,000 will be invested in the market. That hasn't exactly been clarified what it means, but the thought is that it'll be some sort of like market index that tracks to the S&P 500, for example. So the kid can't touch it until age 18. So that money will grow and compound tax deferred. And then whenever they want to take the money out, it all counts as ordinary income. So my thought is, yes, absolutely, you should take this free $1,000 from the government. Where the planning discussion comes in, so parents also have the ability to contribute like $5,000 a year to these Trump accounts. And I'm getting these questions, well, should I use this as opposed to like a 529
I was going to say, is it yes?
Account?
Right.
So the money that goes in there, like I said, whenever it comes out, you pay tax on it. It counts as ordinary income. So to me, it doesn't make sense for parents to. There's better ways in which to save for your children, much more tax advantaged ways than to utilize these Trump accounts.
Right. So you still just right now, and then there's still some uncertainty of how they're being funded. Right. So it's not a matter of like, well, at least we know with a 529 what we're doing and so forth. But keep an eye on it. But right now, there's probably better ways.
Right.
Take the money.
Take the money, but don't add to it.
Right. All right. Well, speaking of children, let's talk about the expanded child tax credit.
Yes. Yeah. So as it stands right now, it's $2,000 per child. And these tax credits, I want to clarify, this is different than a deduction. A credit is if you owe $4,000 in tax, $2,000 credit, it immediately just reduces the amount that you owe. So they're gold.
Right. But we've always been told the credits are far better than deductions, right?
Yes.
Yeah.
So that's been increased. It's $2,200 per child, and that's now indexed for inflation, so that'll increase.
That was the interesting thing, because when I was kind of doing a little bit of pre-gaming here, the index for inflation is pretty interesting. You see that in this bill a couple places, but that is not normally a thing that happens, right?
It depends. I mean, it's there in some things, but I agree that there's a lot more of that, which is great because that means that these benefits, they're just going to increase every single year.
Right, and we don't have to worry so much about the inflation on the benefits where things are slightly different. So that's quite interesting. All right, so we just kind of went through from the birth of a child all the way till like we're getting some credits for the child. Now let's talk about, we're going to send these kids to school. We're going to send them to college, and we're going to get some loans. There's a change kind of in the student loan, right?
Yeah, there's actually some very significant changes to federal student loans. So historically, the federal government, they would pretty much cut a blank check for student loans, right? You say, I want to be a doctor, I want to be a lawyer, and yep, here's the money, and then we'll figure out how you're going to pay it back later. So starting next year, there is going to be a cap on the amount of money that the federal government will loan. So for undergraduate degree, it's $65,000 lifetime total that you can borrow. Graduate degree, so master's or PhD, $100,000 lifetime total. And then if you're going to go to like med school or law school, it's a $200,000 lifetime total. And then the max amount that the federal government will give you, it's $257,500 for school.
Right.
And
that's
so
a big difference, right?
So then what happens is if you need more than that, you have to go to like your local bank and to borrow the money if you don't have it. And the local bank is going to say, okay, Mr. and Mrs. Smith, well, how are you going to pay this back? It's a little bit more, you have to have collateral and that sort of thing. So in my mind, one, I think that this is bad for colleges in terms of how much they can charge for tuition. It just seems like long term this is going to force them, because now they can charge whatever they want. They know that the government's going to come up with the money. And now that's not the case.
Right. And you're going to have a lot of people. I mean, because if you look at colleges nowadays, I mean, you're going to have to take some money out on your own. So, I mean,
Mhm.
this also could affect when it comes to planning, right?
Mhm.
I mean, the 529s or just making sure you have money set aside and not just saying, hey, I'm going to get a loan for this. I don't need to worry about, if I want to be a doctor, I'll have it covered. No, you might want to put some money aside for that, right?
This makes planning and investing in 529s early and often all that much more important.
Right. So it'll be interesting to see how all this works. I mean, we want kids to go to college. We still want everybody to get educated, but now it's just going to be a little bit more planning up until, maybe senior year, fall is the first time you're thinking about college. That might not be a good idea.
No.
I want to plan a little bit ahead. So have those conversations with your kids there. But you're also having conversations with kids, and this a lot of times they're getting their cars.
Yep.
So this has just become a giant kid. This is the whole life cycle of a family here. Well, what do we know about like deductibles on cars?
Yeah. So if the vehicle was made in the United States between 2025 and 2028, you can now deduct up to $10,000 on the interest for your car loan. So that's another nice benefit if you're buying a U.S. made vehicle.
I was going to say, it's right now it's U.S. made vehicles, right?
Mhm.
There's a provision, and I don't know exactly how that is deemed, but it's produced here, and then you're getting this benefit from that.
Exactly right.
Okay. Well, if you're buying cars or having babies, there are some definitely aspects here in 2025 on. Now, how much of this is going to stick around?
Mhm.
Like, is a lot of this kind of until we get another regime or another bill passage or anything like that? A lot of it kind of sticks, though, right?
That's a great question. So the term is, it's permanent, but it's permanent until another party takes
Right.
power. And what changes do they want to, kind of push through to enact their agenda? But it seems like, especially with the tax cuts,
Right.
or I should say, continuation of the tax cuts, it just seems like they're going to be here for a little while, because that would be political suicide to just come in and increase the tax rates. But the national debt is a conversation that we always have to have, and,
Right.
and eventually, will tax rates have to increase in order to help pay off the debt? That remains to be seen.
But every time you see one of these things happen, you see changes there. It comes down to saying, all right, we're going to have to slightly adjust what we're doing, right? Like you can't just blindly say, well, what worked for me 3 years ago is now going to work the same, right?
Mhm.
And that's where it really gets kind of crucial to say, all right, let's look at all these things, because we talked about 10 things, 11 things, really. We got to be a bonus. That some of it might affect you, some of it might not. And there's probably a whole bunch of other things that will affect you that we didn't talk about today, because we're not going through 800 pages and doing a 4-hour YouTube video. But let me ask you this: with anybody that comes in as part of your process, you kind of can look at their profile and kind of utilize your tools to say, all right, this is what you did last year. We're going to adjust this slightly based off what we know and how long this is going. Is that kind of part of your process?
Yeah, absolutely. And it's all about no surprises, right? Like,
Right.
we don't want people to be surprised come April whenever they, have to pay more or they get a bigger refund. It's say,
Right.
this is what's going on. And I also think it's prudent just for people to understand what they have to pay in taxes. Is this something
Right.
you support? Is this something you don't support? A lot of people really have no idea, and they just, they show up and they file there, and they have no idea what happened. And I
Right.
think we all need to have some sort of
Well-
understanding of how taxes work, because it's really important.
Yeah, well, I mean, because of how much you're giving or how much you're getting back and so forth dictates how much you should be saving for college, or if you should be putting money over here or buying a new car. So a lot of decisions be made. So I think the fact is there's a lot of changes that happened that we all need to kind of be educated on. So with that being said, I think this is a perfect segue to say, hey, who the heck can tell them or give them good advice or advice in general on what they should be doing with their money for their wealth management? And I think we're talking to somebody. So Steve, how can we learn more about what you guys do, and how can people connect with you?
Yeah, you can connect with us online. So we're www.raymondjames.wheeling.com. And I'm also on LinkedIn.
All right. And I think we'll be back with more episodes. There's more to talk about, I'm sure, when it comes to all types of legislation and taxes, but things like insurance, things, when it comes to finding a tax advisor and all this stuff. So we welcome you. Thanks for watching. We welcome everybody to subscribe and to follow on social along. We'll be back with more episodes. But thanks to people like Steve and Riverbridge Wealth Management, your wealth building starts now.